35%. $7 trillion. 8 hours. That is what Silver Monday cost the world on January 30th, 2026. Not a slow bleed. Not a gradual correction. A near vertical collapse. The worst single-day wipeout in silver's history since 1980. And if you had money in silver that morning, you lost more than a third of it before the closing bell rang. But here is the real question. The one that Wall Street does not want trending. Was this a crash? Or was it a controlled demolition? Because on that same day, 3 things happened simultaneously that have no clean explanation. The London Metal Exchange went dark, HSBC's trading systems went offline, and the CME, the most powerful commodities exchange on Earth, hiked silver margin requirements in the middle of the freefall, forcing millions of investors to sell at the worst possible moment. This is the story of Silver Monday. Every number, every anomaly, and every question that is still unanswered 3 weeks later. To understand January 30th, you need to understand what came before it. Silver closed 2024 at around $30 an ounce. In the 12 months that followed, it surged over 240%. Then, in the first 4 weeks of 2026 alone, it climbed another 60%, crossing $100 for the first time in history and peaking at $121 just days before the crash. 2 forces were driving it at the same time. The first was fear. U.S. consumer confidence hit a 10-year low in January 2026. Trade wars, a weakening dollar, and political instability pushed investors toward hard assets with real-world scarcity. Gold went with it, climbing more than 80% in 2025 alone. The second force was something more durable, industrial demand. Silver is no longer just a store of value. It is a core material in the 3 technologies defining the next decade: solar panels, electric vehicles, and the semiconductors powering the AI revolution. Every solar panel uses 0.64 ounces of silver. Every EV uses nearly twice the silver of a combustion engine car. And AI semiconductor demand alone is projected at 23 million ounces per year by 2030. The global silver market has run a supply deficit for 5 straight years. Demand has exceeded production every year since 2021. That structural story is real, and it was pulling serious institutional capital into silver alongside retail speculators. By the time prices hit $121, the market was stretched. But the fundamentals behind it were not invented. And then came the trigger. January 30th, 2026. President Trump announced his nominee for the next Federal Reserve Chairman, Kevin Warsh, a hawkish former Fed governor widely seen as favoring higher interest rates for longer. Markets reacted immediately. Higher rate expectations strengthened the dollar and reduced the appeal of non-yielding assets like silver and gold. The initial sell-off was sharp, but not unusual. What followed was, here is what most retail investors do not understand about the silver market. The overwhelming majority of silver traded globally is not physical. It is paper, futures contracts, synthetic positions. According to data analyzed after the crash, the ratio of paper silver to physical silver in the market was approximately 350 to 1. 350 paper ounces traded for every single real ounce that existed in the world. That ratio creates a specific and well-documented vulnerability. When prices fall sharply, leveraged investors face margin calls. They must either post additional collateral immediately or close their positions. Forced selling drives prices lower. Lower prices trigger more margin calls, more forced selling. A self-reinforcing spiral that, once started, does not stop on its own. That spiral started on January 30th, and then the CME poured fuel on it. In the middle of the crash, the CME raised margin requirements on silver without warning. It made it more expensive, at the worst possible moment, for investors to hold their positions. The result was a second wave of forced liquidations on top of the first. Morningstar described it plainly. Positioning, leverage, and liquidity constraints triggered mass liquidation. Nearly $7 trillion in combined gold and silver market value erased in a single session. Price swings normally spread over an entire year, compressed into 8 hours. Now, 3 anomalies that day have generated serious questions, and it is important to be clear about what the data shows and what it does not. First, the London Metal Exchange, the world's oldest and most important metals trading platform, experienced a systems outage during the peak of the crash. The LME has attributed this to a technical issue. No evidence of deliberate interference has been established, and the exchange has not been charged with any wrongdoing. What is factual is the timing. International price discovery was disrupted at the exact moment it was most needed. Second, HSBC, one of the world's largest precious metals dealers, reported a system failure that prevented clients from executing trades during the same window. HSBC has not commented publicly on the specifics. No regulatory action has been taken. The coincidence of 2 major system failures at the same institution level on the same day remains, at this point, unexplained. Third, the question of short positioning by major financial institutions. It is publicly documented fact, confirmed by a $920 million settlement with the U.S. Department of Justice and the CFTC, that J.P. Morgan engaged in systematic manipulation of gold and silver markets between 2008 and 2016. That is not allegation. It is admitted, settled, and on the public record. In the context of that documented history, multiple independent market analysts have noted that data patterns on January 30th are consistent with a large institutional short position being closed near the intraday bottom of the crash. A trade that, if it occurred as described, would represent one of the most profitable single-day positions in silver market history. J.P. Morgan has not confirmed or denied any specific positioning on that date. No investigation has been announced. The observations of market analysts represent their reading of publicly available trading data, not established legal findings. We present them as questions the data raises, not as conclusions. What is not in question? Whoever held large short positions going into January 30th, 2026, made an extraordinary amount of money that day. And the mechanisms that accelerated the crash, margin hikes, exchange outages, forced liquidations, disproportionately hurt retail investors who had no tools to protect themselves. What happened after the bell rang? The physical market told a different story than the paper market. Physical silver dealers reported record premiums, buyers willing to pay substantially above the crashed spot price to obtain real metal. The iShares Silver Trust ETF logged over $40 billion in single-day trading volume, more than Apple and Amazon combined on the same day. The physical market was not in panic, it was in accumulation. By the following Tuesday, silver had rebounded to $88, then it pulled back again. As of today, February 20th, 2026, silver trades around $80 an ounce, down 34% from its all-time high, but still up more than 160% from 1 year ago. Is silver a buy, a sell, or a trap right now? The structural case remains intact. 5 consecutive years of supply deficit, accelerating industrial demand from solar, EVs, and AI, a physical market that held premium pricing even through the crash. These are not narratives. They are verifiable data points from the Silver Institute and the U.S. Geological Survey. The short-term risk is real as well. The speculative positioning overhang from the 240% rally has not been fully cleared. Silver is more volatile than gold, more sensitive to economic slowdown, and carries the weight of the events of January 30th in its market psychology. Analysts at Fontobel and Morningstar both flagged continued vulnerability until that excess positioning resolves. One number summarizes the fork in the road, the gold to silver ratio. Historically, it averages around 70. Today, it sits significantly above that. When this ratio is elevated, it has historically resolved in one direction, silver recovering toward gold, more often than the reverse, but historically is not a guarantee. And in a market where 350 paper ounces exist for every real one, history is always being rewritten. Here is the lesson Silver Monday should leave with every investor. Whether or not you ever owned a single ounce, paper markets and physical markets can diverge violently. And when they do, the paper market wins in the short run, because it has leverage, margin calls, and exchange-level mechanisms that individual investors cannot access or defend against. The Hunt brothers in 1980, the retail silver squeeze of 2021, Silver Monday in 2026. 3 different eras, 3 different triggers. The same ending. The paper architecture reasserted control, and in each case, the investors least equipped to respond held the loss. This does not mean you should not own silver. It means you should own it with your eyes open. Know whether your exposure is paper or physical. Know your time horizon. Know that in a market where 35% can disappear in 8 hours, the assumption that you will have time to react is the most dangerous assumption you can make. The 350 to 1 ratio has not changed. The leverage is still in the system. The architecture is still in place. Silver Monday happened once. The conditions that made it possible are unchanged. Stay informed. Know what you own. And never confuse a contract with the metal itself, because in the end, only one of them is real.